Capital allocation and shareholder value creation. Capital allocation refers to management's decisions regarding how corporate resources are invested, financed, and distributed to shareholders. Effective capital allocation is one of the most important drivers of long-term shareholder value because even highly profitable companies can destroy value through poor investment decisions. Management must determine whether excess cash should be reinvested in operations, used for acquisitions, applied toward debt reduction, held as liquidity reserves, or returned to shareholders through dividends and share repurchases. Analysts evaluate whether management consistently allocates capital toward projects that generate returns exceeding the company's cost of capital. Sustainable value creation depends not only on profitability but also on disciplined and efficient deployment of financial resources. Evaluating management's capital allocation decisions. When assessing capital allocation, analysts examine historical investment decisions and their impact on shareholder returns. Capital expenditures, acquisitions, research and development spending, and share repurchase programs should all be evaluated relative to their economic outcomes. Investments that generate returns above the required rate of return increase firm value, while projects that fail to earn the cost of capital reduce shareholder wealth. Analysts also consider whether management prioritizes growth appropriately or pursues expansion simply to increase company size. Understanding management incentives, compensation structures, and governance practices can provide insight into future capital allocation behavior and the likelihood of continued value creation. Integrating earnings quality into financial analysis. Earnings quality remains a central component of comprehensive financial analysis because reported earnings often serve as the foundation for valuation models and investment decisions. Analysts seek to determine whether earnings are sustainable, recurring, and representative of underlying economic performance. High-quality earnings are generated primarily through core business activities and are supported by corresponding cash flows. Low-quality earnings may result from aggressive accounting choices, one-time gains, changes in estimates, or temporary economic conditions. Before relying on reported earnings for forecasting purposes, analysts should identify unusual items, assess accounting policies, and determine whether current profitability accurately reflects the company's long-term earnings-generating capacity. Cash flow analysis as a validation tool. Cash flow analysis complements earnings analysis by helping analysts verify the quality and sustainability of reported profits. Operating cash flow is generally less susceptible to accounting manipulation than net income and therefore serves as an important measure of financial performance. Analysts compare earnings trends with operating cash flow trends to identify potential discrepancies. Significant differences between earnings growth and cash flow growth may indicate aggressive revenue recognition, delayed expense recognition, or unusual working capital changes. Strong companies typically generate consistent operating cash flow that supports earnings, capital expenditures, debt obligations, and shareholder distributions. Consequently, cash flow analysis provides valuable insight into financial strength and earnings reliability. Combined assessment of earnings and cash flow quality. A comprehensive assessment of financial performance requires simultaneous evaluation of earnings quality and cash flow quality. Analysts frequently adjust reported financial statements to remove non-recurring items, normalize earnings, and isolate sustainable operating performance. The persistence of earnings, the magnitude of accruals, and the relationship between earnings and cash flow are particularly important considerations. High-quality companies generally exhibit stable earnings, strong operating cash flow, conservative accounting practices, and transparent disclosures. In contrast, persistent reliance on accruals, repeated restructuring charges, or weak cash generation may signal elevated reporting risk. Integrating earnings and cash flow analysis improves forecasting accuracy and enhances valuation reliability. Understanding market value decomposition. Market value decomposition seeks to identify the key drivers of a company's market valuation by separating value into its underlying components. Rather than viewing market capitalization as a single figure, analysts decompose value into contributions from operating assets, growth opportunities, financing decisions, and expectations regarding future profitability. This process helps explain why companies with similar accounting earnings may trade at significantly different valuations. Market value reflects investor expectations regarding future cash flows, growth prospects, risk, and management effectiveness. Decomposition therefore provides a framework for linking financial statement analysis directly to valuation and understanding the factors driving investor perceptions of value. Linking financial statement analysis to valuation drivers. Market value decomposition highlights the relationship between accounting information and firm valuation. Earnings growth, return on invested capital, asset efficiency, capital structure, and cash flow generation all contribute to market value. Analysts evaluate whether current valuation levels are justified by the company's financial performance and future prospects. A firm generating returns above its cost of capital typically creates economic value and commands higher valuation multiples. Conversely, weak profitability, poor capital allocation, or deteriorating earnings quality may reduce market value despite strong reported accounting results. Understanding these relationships enables analysts to identify potential mispricing and assess investment opportunities more effectively. Integrated application for CFA candidates. The program emphasized the importance of integrating capital allocation analysis, earnings quality assessment, cash flow evaluation, and valuation techniques into a unified framework. Effective analysts move beyond isolated financial ratios and instead focus on how management decisions influence profitability, cash generation, risk, and shareholder value. Strong capital allocation supports sustainable earnings growth, high-quality cash flows reinforce confidence in reported performance, and market value decomposition connects financial analysis directly to investment valuation. For CFA candidates, mastering this integrated approach is essential because it mirrors the analytical process used in professional equity research, portfolio management, credit analysis, and corporate finance decision-making.